Hi, this is Gavin from Options Trading IQ. This is the second video in the Long Strangle Option Strategy series. Today we're going to be looking at when to enter trades, and we're going to be looking at some examples. Okay, so in terms of entry signals, choosing the right time to enter a long strangle can have a significant impact on profits. One good entry criteria could be to wait until the stock has had a long period of sideways consolidation before entering the trade. Look for stocks that are range bound or coiling in a tighter and tighter range. They could be ready for a breakout. Here's a couple of good chart patterns to look out for. So the flag pattern is a good one. You can see that the stock is consolidating there within the red lines in a very, very tight range, and it looks ready for a breakout. When it does break out, it can have a very large move. So that's what you want with a long strangle. Another good signal that I like to use is a Bollinger Band squeeze. Using Bollinger Bands is a great way to tell when a stock might be due for a breakout. This works especially well when the Bollinger Band width is near the lowest point seen in the last 6 months, and when the stock price is near the middle of those very narrow Bollinger Bands. In this chart of EWZ on the left, you can see two very favourable entries based on these criteria. So early March, that first green line, the Bollinger Band width, as you can see in the top, is very, very narrow, and the stock is about near the middle, and then it has a pretty severe drop from 35 down to about 29. And again later on in May, very narrow Bollinger Bands, the stock's about in the middle, and it drops from around 36 down to about 32 over the course of 6 or 7 trading days. So that's exactly what you're wanting to see when you enter a long strangle. You want the stock to make a really big move not long after you put on the trade. Usually it's preferable if that happens to the downside, because there's going to be an associated increase in implied volatility. So in both of these instances, the long strangle trade would have got a nice boost from an implied volatility jump. So a little bit more on volatility. So long strangles are long volatility trades. So you want to be entering them when volatility is low and expected to rise. You can see two periods on this chart when implied volatility experienced a sharp rise. Long strangles would have done well at this time. So again, those are the two periods that we just looked at. Implied volatility shot up from around 31% to about 38%, and in the second case from around 26% to about 33%. Here's another example on JP Morgan this time. Between mid-June and early August, JP Morgan traded in a very tight range before falling from 68 to 50. In this time, a December 65.70 long strangle went from $3.50 to $7.75. I'm going to take a look at some examples now on Russell. So put these trades together on June 15th, 2015, when the Russell was trading at 12.61. Put on 3 different strangle trades. So the first trade was a sort of standard one, 3-month duration, 50 points either side. The second one we went further out in time, so the same strikes, but we went out to January 2016. And the third one we went further out in price. So we stuck with September, but we went 100 points out, so 1160 and 360. So you can see there the cost of the trades and the various Greeks. Obviously the January one cost the most because it was the furthest out in time, and the September one, the third trade, cost the least because it was further from the money and short in duration. On August 24th, 2015, the RUT dropped to 11.25, so that was a drop of nearly 11% since the trade initiation. So let's take a look at how our strangles did. The first trade made 5,125 or 114%. The second trade made 2,525 or 26%, and the third trade had the biggest gain in terms of percentage, 178%, and a total of $3,955 profit. So really interesting there. Take a quick look at those and see how the different trades performed. The first one did the best in terms of dollars, third one did the best in terms of percentage, and the second one, somewhat surprisingly really because it had the highest Vega exposure, did the worst. Another thing to note here is the Greeks. So obviously all of these three trades are really skewed to the downside now. They've got a lot of negative delta because all of the value of this trade now is in the put. The calls are, I won't say worthless, but the calls are very low in value. There's a lot of value in those puts. So what you wouldn't want to have happen is here for the stocks to, for the Russell to shoot back up with a lot of negative delta. You're going to be giving up profits if that happens. So, you know, probably a good point to take some profits here. The Vega has really dropped as well. As these trades progress through time, the Vega exposure reduces, and the Theta has picked up. So you'll notice that those are higher than in the previous screenshot. That's because we've got less time to expiry now, so Theta is accelerating. Okay, thanks for watching. I hope you enjoyed this video, and remember to head over to optionstradingiq.com for more great articles and videos.